This is a very active time in the market, I don't have to tell you. But this week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08, 09, the tech and telecom bubble in 2000, and 1987.
The recent global stock market downturn, which quickly spread to other sectors, including cryptocurrency, has left investors and traders anxious about the future of the U.S. and global economy. Despite a rebound in the past few days, concerns persist, especially as legendary investors like Warren Buffett have been increasing their cash reserves at the fastest rate since just before the 2007 global financial crisis. Buffett's Nebraska-based conglomerate, Berkshire Hathaway, has reduced several stock positions and significantly cut its stake in Apple, its largest holding. This move is being interpreted by investors and traders as a sign that Buffett is preparing for a larger crisis in the coming months. Berkshire's cash and equivalents have reached a record $276.5 billion, returning to levels seen in the early 2000s, just before the last major financial crisis, when Buffett famously acquired numerous investments at rock-bottom prices. In a recent video update, ARK Invest founder, CIO, and CEO Cathie Wood suggested that the recent market crash could be a precursor to a more severe crisis, one that might rival the 2008 to 2009 financial meltdown in both intensity and duration. According to Wood, the current situation represents a complete purge, as the market adjusts to recent developments and repositions itself for the new economic environment. She believes this purge is far from over, warning that there is much more turbulence ahead. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy, and maybe the global economy, has been going through a rolling recession ever since the Fed started raising interest rates. Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan, so playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets. And now the VIX has calmed down. Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility. But I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now, one last thought here. Interest rates coming down should be very positive for the equity markets, but they will not arrest a recession very quickly. In fact, if consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait.
Cathie Wood believes that the recent crash will fundamentally change investor behavior and reliance on current benchmarks. At present, the Magnificent Seven dominate the stock markets, and during turbulent times, investors often turn to these giants for reassurance. However, Cathie's Florida-based investment management firm, ARK Invest, has been heavily investing in disruptive innovations since its inception in 2014. She believes that technologies like artificial intelligence, DNA sequencing, CRISPR gene editing, robotics, electric vehicles, energy storage, fintech, 3D printing, and blockchain will gradually replace the current market benchmarks. This is why she's so committed to these technologies, predicting that their market value will grow exponentially from less than $20 trillion today to over $200 trillion by 2030. In contrast to Cathie's less optimistic short-term outlook, Fundstrat's Tom Lee believes the worst of the stock market turbulence is behind us. Earlier this week, Lee noted that the CBOE Volatility Index, which made history by soaring 172% on Monday, is now cooling off, suggesting that the stock market has reached its bottom. Lee echoed this sentiment in a recent CNBC interview, explaining that the recent crash was driven by market concerns over the threat of war, red flags in the U.S. labor market, and the unexpected unwinding of the Japanese carry trade. He believes that these issues are now being appropriately addressed, and the market is shifting its focus to more positive developments. Here are some clips from the interview.
The thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us. Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade?
Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive, because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Cathie Wood and Tom Lee have offered contrasting perspectives on what lies ahead for the markets. Cathie anticipates more turbulence for the U.S. and global economy, particularly in the mid to near term. On the other hand, Lee, who is more focused on the short term, believes that the worst is behind us and that the recent market rebound will continue for a while. However, Lee doesn't rule out the possibility of further disruptions if new issues arise, such as signs of a weakening U.S. labor market, an escalation in the Middle East conflict, or other factors that could quickly unsettle the markets, similar to what occurred late last week and on Monday. Please share your thoughts on Cathie's and Tom's viewpoints in the comments section below, along with your own assessment of the current market situation. Do you agree with Cathie that more turbulence is on the horizon, or with Lee's analysis that a major market unraveling is unlikely to happen? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.